Hello to everyone and welcome to a beautiful subject of accounting. So, today is our first session on the topic basics of accounting. Now, what are the things that we are going to learn during this particular session? So, let's understand. So, as I mentioned, the subject topic is basics of accounting, and this is part one. Many more sessions on this topic where we can uncover the subject. The subject will evolve over a period of time from a number of sessions that we are going to have in times to come. Now, what are the areas that we are going to discuss in this particular session? Now, important areas that we are going to cover in this session are layers of accounting, process of accounting, meaning of accounting, and users of accounting information. Now, when we understand a subject like accounting, basically money comes to our mind. An accountant is one who keeps a record of money. We talk about business. There is inflow of money when the business is selling. There is an outflow of money when the business is purchasing. So keeping a record of that money coming in, money going out, and lot of other business related information is covered in the subject of accounting. So when we are talking about the layers of accounting, I call this concept as BRAT. There are 4 layers, and each of the letter B, R, A, and T has a specific meaning. So let's understand the layers of accounting. The letter B stands for bookkeeping. The letter R stands for rectification. A stands for adjustment, and T stands for transfer. So accounting has these 4 layers. When we begin, we talk about bookkeeping because we say where bookkeeping ends, accounting begins. So bookkeeping is the first and the foremost thing that we have in accounts. Then we have these aspects like rectification, adjustments, and transfer. Let's understand each of these layers in detail. Now, what is bookkeeping? Now, basically, if I say in a layman's language, bookkeeping would mean keeping the books in order, like how you keep the books in the shelf in your study room, or how a librarian stocks his books, in his library, depending upon the type of book or the subject of the book. In accounting, there is something little additional. Here, bookkeeping refers to keeping a record of all the monetary information. So I just mentioned earlier, monetary would mean money related information of a business in its books of accounts in a systematic manner. We have to understand there are 2 systems of accounting, we say. One is called as the single entry system, and another one is called as a double entry system. So recording all monetary information, all money related information of a business in the books of accounts in a systematic manner, that is called as bookkeeping. Now let's understand this. Library books kept in order. A librarian may call it as bookkeeping. But as far as bookkeeping terminology in accounting is concerned, writing inside the accounting book in order, that is called as bookkeeping. So how are you going to record the items? Money coming in, money going out, all the incomes, all the expenses. How are you going to show inside an accounting book? That is called as bookkeeping. So understand. So bookkeeping in accounting doesn't mean keeping books in order. It would rather mean writing inside the accounting books in order. That is called as bookkeeping. So I hope you have understood this particular concept. Let's move to the concept of rectification. See, accountant is a human being. And as a human being, he is bound to make mistakes. So as and when he is recording inside an accounting book, right here we have, or suppose say he is recording the accounts in a computer for that matter, in a particular accounting software. It is the mistake that may occur as a result of an accountant recording a wrong amount, either in the book or on a computer for that matter. And such mistakes are referred to as an error. So mistakes are referred to as errors in accounting. And very, very important, as and when an error is located, it must be rectified. You cannot postpone rectification or correction of those errors in future. You have to rectify it then and there. And the entry that we pass to rectify an error, that entry is called as a rectification entry. So accountant is a human being. He is bound to make mistakes. Now, as and when those mistakes, or we call errors in accounting, are located, such errors need to be rectified. And the journal entry, or rather you can remember an entry that we pass to rectify an error, these are known as rectification entry. So that's about the letter R for rectification. Then we talk about adjustment. What do you mean by adjustments? As you see over here, railway tracks, in all directions, you can say north, east, west, and south. Now, similarly, in the subject of accounting, an accountant comes across a number of adjustments, like closing stock, like bad debts, like making a provision, like outstanding items, like prepaid expenses, like received in advance. So there are so many adjustments that an accountant may come across at the end of the accounting period. And these adjustments have to be incorporated. These are to be included in the books of accounts. And the entries that we pass to accommodate or include such adjustments are called as adjusting entries. And remember, the job of an accountant is more so like multitasking. It is not just about income, it is also about expenses. It is not just about assets, it's also about liabilities. It's also about equity. It's also about outstanding payable items, receivable items. So you can say an accountant really has to multitask. And these adjustments have to be incorporated in the books of accounts by passing adjusting entries. So that's about the letter A. Next, we move to the letter T, which is transfer. At the end of the accounting period, some balances are to be transferred from one account to another account. And these transfer can happen by passing what is called as transfer entries. So transfer entries helps by transferring balances from one account to another account. So transfer entries are also to be shown at the end of the accounting period. That's why we have the relevance of transfer entries as far as accounting subject is concerned. Next, we are moving to something which is very, very relevant, and that is called as the process of accounting. That is called as the process of accounting. Now, the entire concept of process of accounting begins with what is called as a transaction or an event. So we will be discussing each of this particular concept in our next session. What do you mean by a transaction? What do you mean by an event? Now, the business can travel either the journal way or the subsidiary book way. So business can maintain accounts based on any one of the two methods. Either the business goes through the journal way or the business goes through the subsidiary book way. Whether they take the journal route or whether they take the subsidiary book route, both meet at a point called ledger. Both meet at a point called ledger. And the balances of various ledger accounts help in preparing what is called as trial balance. What is called as trial balance. So balances of various ledger accounts will help the business prepare trial balance. Now, as far as subsidiary books are concerned, we have quite a few subsidiary books called purchases book, sales book, purchase returns book, sales returns book. Then we have bills receivable book, bills payable book, and journal proper. So we have at present, as you see on the screen, there are 7 subsidiary books, but there is an 8th one also, which I will discuss. Now, purchases book, whatever is the balance in purchases book, that will be shown in a ledger account called purchases account. Sales book, whatever is the balance in sales book, that balance will be shown in an account called sales account. Then we have purchases returns book. Whatever is the balance in purchase returns book, that will be shown in an account called purchases returns account. Sales returns book, balance in this book will be transferred to the ledger account called sales returns account. Bills receivable book, the balance will be transferred to an account called bills receivable account. Bills payable book, the balance in this book will be transferred to an account called bills payable account, which is maintained in the ledger. And journal proper, again a subsidiary book, will be transferred to respective accounts in the ledger. So you see the 7 subsidiary books which is specified so far on the screen all go to ledger. Purchases book is different from purchases account. Sales book is different from sales account. Purchases returns book is different from purchases returns account. Sales returns book different from sales returns account. Bills receivable book different from bills receivable account. Bills payable book different from bills payable account. And journal proper, we have specific accounts which is entered in the ledger. Then we have the 8th one right here, and that is called as cash book. Point to note, cash book and cash account are one and the same. Cash book and cash account are one and the same. So cash book need not go to ledger account. Rather, the cash book balance will directly go to what is called as trial balance. So understand, purchases book, sales book, returns book, sales returns book, bills receivable, bills payable book, journal proper. All these books are different from the accounts, but cash book and cash account are one and the same. Cash book and cash account are one and the same. That's why the cash book doesn't go to the ledger. It goes to the trial balance. And from the trial balance, along with adjustments, we prepare what is called as final accounts. We prepare what is called as final accounts. And in final accounts, there are 2 parts. One is trading and profit and loss account. And the second part is known as balance sheet, or we also call that as position statement. So trading and profit and loss account is also called as income statement, and balance sheet is also known as position statement. So this is the process of accounting that we need to understand. And also below the trial balance, we come across items like rectification of errors. We come across bank reconciliation statement. We come across end of the accounting period adjustments. That is below under the concept of trial balance. We come across rectification of errors. We come across bank reconciliation statement, and we come across end of the accounting period adjustments. So this is about the process of accounting. Now let's understand. Let's focus on this word process of accounting. Let's understand what is the subject matter accounts made up of. Meaning of accounting. There are meaning given by the American Institute of Certified Public Accountants in 1941 and also given in 1972. But in comparison to both those meanings, the meaning of accounting as given by American Accounting Association in 1966 is very, very relevant. What does American Accounting Association say about the meaning of accounting? Accounting is the process of identifying, measuring, and communicating. It is a process of identifying, measuring, and communicating. If I go back, process of identifying, what we do from journal to ledger is identifying. What we do in a trial balance is measuring. And through final accounts, it is communicating. So process of identifying, measuring, and communicating. Economic information. Economic information means money related information, monetary information. For what purpose? To permit informed judgments and decisions by the users of the information. So by recording all money related information, the business is helping out the user of the information to take informed judgments and decisions. For example, if I'm talking about a company, I have bought or invested in the shares of a company. So company accounts will help me get complete knowledge about the dealings, the monetary dealings of the company. So I will be very, very clear, and based on such monetary information, as a shareholder, as an investor, I can take the right decision. Remember, informed decision. Informed based on available complete information, I can take the right decisions as far as staying in that company or moving out of that particular company. Now, I mentioned about permitting informed judgments and decisions by the users of the information. Who are the users of the accounting information? Basically, the first set of people who are going to use accounting information are insiders, that is shareholders or owners of the company. They would like to know, what has been done with their money in the company, how the company has utilized the money for its further growth. The second party who will be using the accounting information are the management, the board of directors. They would like to know how has been the performance of the company in this particular year, whether the company has done well or whether the company is lacking somewhere. So management will also be looking or using the accounting information. Then we have employees who are working in the organization. Their benefit, has the company earned good profit this year? Are we going to get a bonus? Are we going to get an increment? Or is there something additional in monetary terms that is coming our way based on the result of the business? Then we have creditors or vendors of the company. Who are creditors? Creditors are people who supply goods to the business or raw materials to the business on credit. Their payment is delayed by the company. So creditors are people who have supplied raw materials or goods to the business on credit. Who are vendors? Vendors are people who have supplied assets like machinery, like furniture, like buildings to that particular company. They are known as vendors. So vendors are people who have supplied assets to the company. So they will be equally interested in using the accounting information. Next, definitely we have government, because government keeps track of all the public companies, especially because when public money is involved, the registrar of companies, the Ministry of Corporate Affairs, and all the government departments will be focusing on the working of such a company. Because when public money is involved, there is a huge risk, there is a huge stake, because when public lose their confidence, within weeks, the company may close down. As far as, company not showing performance, or the company which is reporting any kind of misappropriation of money. So government will definitely take care and see to it that the company is within the framework of the Companies Act of 2013. Then we have tax authorities, the income tax department, the Central Board of Direct Taxes, that is, I'm talking about the income tax department. Similarly, we have the GST department, the customs, in case if the company is into import and export of goods, and also indirect tax authorities like GST. They will also be looking at whether the company is paying its income tax, whether the company is collecting GST and also transferring that GST to the state and the central government respectively based on the kind of transaction. So tax authorities will also have an eye on the working of the companies as far as their taxes are concerned. Next set of people who will be interested in using the accounting information are the prospective investors. These are people who have money. They want to invest their money in the company. So definitely, when I want to invest my hard-earned money in a certain company, I would like to do a research about the company, whether the company is really fulfilling its objectives or not, or the purpose for which it has come into existence. If I believe the company is doing well, the company is going to give me good returns in the course of time, then I will close my eyes and invest my money in such a company. But prospective investors have to do what is called as research about the company. In legal terms, we call that as due diligence. So due diligence has to be done by the prospective investors. Next, we talk about general public. See, though general public are not directly associated with the company, general public will definitely be interested as far as working of the company is concerned. Let's take environmentalist among the general public, whether the company is following environmental norms or not, whether the company is fulfilling its CSR regulations or not. So general public in the neighborhood will definitely show interest as far as the working of the company is concerned. Then we have society. Company or any business existence is because of society. If the company is earning profit, society is responsible for it. So very important, the society is looking at whether societal accounting, societal concerns are taken into account or not. Whether the company is taking care of or restricting its pollution or not. Because the company has to survive, the society also has to survive. So we talk about sustainable development as far as company is concerned. So we have social responsibility accounting, which society would definitely be interested. Environmental accounting, how much of protection is the company making available as far as its surroundings or environment is concerned. Because if it is an hazardous company, if it is into petrochemicals, if it is into chemicals and fertilizers, then these are hazardous companies. So the society will definitely be interested what kind of precautions such companies are taking in reducing its carbon footprints or in reducing its pollutions, reducing its pollution. Then we have the SEBI authorities, Securities and Exchange Board of India. SEBI, we can say, governs the working of all the stock exchanges in India. So SEBI authorities will definitely look into the matters of the company, make use of the accounting information, because as per Companies Act 2013, all public companies must be compulsorily listed. And if it has to list, it is the SEBI which is going to put forward all the guidelines. So if the company is doing business now for years together, SEBI would keep an eye on such companies, on such businesses, and see to it that all SEBI guidelines, all Companies Act rules of 2013 are followed by the company. So these are basically the users of the information: shareholders, the management, the employees, the creditors or vendors, the government, the tax authorities, prospective investors, general public, society, and SEBI authority. So these are the people who will definitely be interested as far as the company is concerned. So that's all I have in this particular session of Basics of Accounting Part 1. If you have liked the presentation, definitely you can give a thumbs up, you can like, you can subscribe to the channel, and also do comment. So let's meet again in the second part of the session on the topic Basics of Accounting. Till then, thank you.